Hi, Stuart Chung here from Commercial Finance Expert Academy. I'm the creator and founder of the Commercial Financing Fast Track and Commercial Finance Mastery course. Today, I'm here to help answer a question that I often get from other mortgage brokers as well as clients. Same. They always ask me, Sue, what is the interest rate that I should expect on these commercial properties? Or what kind of rating, pricing, how do they figure out at the bank level that what do I qualify for and for how much, right? So those are loaded questions. Simply put, I'll give you an idea how they determine what the interest rate or pricing is for commercial properties that we have when you bring them a loan request to get financing on the property you're either buying or refinancing. Okay, so either way, it doesn't really matter. They are pretty much the same, unlike residential financing. Right? For commercial financing, to understand how they come up with the interest rate or pricing, as we call it in the commercial financing space, is you have to look from the top down, right? So the type of property, for one, will determine what pricing they will have. So what kind of interest rate you will start with, basically, right? So for example, if you have a multifamily apartment building, 5-plex, 6-plex onward, right? You have two choices. So one is a class of type of property. The class is multifamily. Let's deal with multifamily first, right? What two types? Either 5 units, 6 units, smaller units, right? The pricing typically are higher, right? So the more units you have, the likely chance that you're getting a low interest rate or pricing is very high, right? So high chance of low interest rate. I know, right? To understand that, that's simply put, okay? Now, let's look at the other type of property. I'll get back to this in a bit about the aspects of the types of financing from lenders in a bit. Other types, other class of properties you look for financing is it medical building, office building, or is it mixed use, right? And mixed use type of property could be retail, it could be office building and retail and residential together. And there's different ways that people have built over the years, either office space upstairs and retail space below, or medical building upstairs and retail below, or residential upstairs and be retail or office below, right? Those complicate things a little bit more, especially when they split with residential and commercial, right? The finance is a little bit tricky, and the lender's appetite is another thing that I'll discuss about in a minute. So let's go back. What types of class of property? So if you have a type of property that they can't really package together and sell off as mortgage-backed securities or other types of mortgage-backed financing where they can bulk sale to either real estate, investment trusts, and pension funds, etc. Right? If you have a property that is typical, conventional, so 75% loan to value, for example, 25% down, anywhere around the world, you can pretty much get this kind of financing. This is what you call standard issue financing, where you have retail or office building, and it's pretty straightforward. One unit like warehouse, or one unit storefront property, or an office for, say, a lawyer or an accountant, right? Those are simply conventional financing. They can be done at the retail level of the bank or credit unions, right? Those financing I find are the status quo, I call it. They're typically between half a basis point to 1.5 basis point higher. So 50 to 150 basis point higher than any kind of residential financing you can expect. Now, let's go back to multifamily. Multifamily is kind of a niche in its own. They're below 4 units, so they don't really qualify with most lenders on the residential level. So if you have 5 units or more, typically they go to commercial side, right? So residential side is less than 4 units or less, usually, right? Some lenders can go 5 units or 6 units on the residential side, right? Which is kind of cool, but we're not dealing with residential right now, okay? So we're dealing with commercial. So today's commercial, on the commercial space, there's two types. One is insured, right? Meaning that it's a higher loan to value than 75%, for example, or 80% for that matter. Certain lenders with anything over 75% is called insurable financing. and which they can package these types of properties together into a huge giant portfolio and sell it off to pension funds or real estate investment trusts, etc., or to the public market, right, to securities market. And I won't get into that detail because that's not my expertise and my forte. I won't talk about it, but I will talk to you about the pricing and the interest rate, right? So pricing, if it's insurable, it's insured and it can be packaged together and good quality, usually AAA types of property. They're not going to require any kind of, I say, repairs or renovations or low vacancy. It's already, you're talking very good, stable rental portfolio. The rent rolls are great, and you can get cheap financing. Now, the financing on these properties are typically lower than residential financing. Believe it or not, I've seen even 0.5%, so 50 basis points lower than conventional residential financing. Now, you may ask why. Well, that's easy because they can take the money and roll it over, take a little bit of profit, sell off that interest, that higher interest rate to commercial side, right? Now, if they do not qualify, for example, if the property requires some kind of renovations and the rents are pretty low, meaning that there's a potential to go increase the rent down the road, but right now there's not enough to debt service. Chances you won't get the high loan to value to qualify for the insured secured mortgage for that. In Canada, we call CMHC insured mortgages for the multifamily, and it's so cheap. Literally, you're talking about a quarter point to half a percent lower than the residential financing rate now on the same 5-year fixed term or 10-year fixed term for that matter, right? So how crazy is that? It's cheap money, right? And that's why a lot of multifamily are being built because it helps with the government's mandate, right, to get affordable housing, and that's the reason why you get the low interest rate, so that hopefully the low interest rate will get passed on to the tenants that live there, right? Anyhow, if you do not qualify, then you'll be qualified just a status quo. Any retail space, office building, etc., it'll be the same on conventional side. The rates won't be any different, right? So hopefully that answers your questions. There is other factors too, such as, is this person high net worth? Is this person got stellar experience doing this kind of property? How do they have past experience managing these type of property or not? Or do you have professional teams that take care of it, right? That kind of allays the fear, the risk of the lender a little bit lower. So you may get another, 5, 10, 15 basis points lower than the initial the quote that they give you. Yeah, so that's the coolest thing is that in commercial financing is the first quote that you get might be a higher quote, and eventually, if you show them enough, provide enough proof that you're a good bet, then the rates at the end will be lower than what you got initially, right? Which is kind of cool. Right? I've had it happen countless times with the files that I have with my clients. Now, this is the reason why I'm telling people that you need to get professionals like mortgage brokers to help you. But one thing is this: every lender, commercial account manager that exists at the bank level, right? They're based on commission. So their commission, the base salary starts X amount, for example, right? And if they get enough clients and they get enough volume, the commission gets higher and higher and higher, right? The higher the profitability that they get for the lender, their commission, the bonus, is also reflected as much. That being said, if you don't have an existing relationship with those lenders that you're currently doing business in the past, chances are you walk in, you're not going to get the highest. You won't get the highest rate, possibly, but you might not get the lowest rate either, right? The best pricing is based on a few factors too: the volume, the dollar amount, right? The higher dollar amount you bring to the table, you get the loan. Chances are you get a lower interest, right? If you get needs a little $500,000, $1 million deal for the loan, right? It's not a lot of incentive for them to give you the lowest rate. You got a $10, $15 million deal or more, then yeah, chances you can shave off a few basis points, right? 5, 10, 15, 25 even, right? So is that a big deal? Of course this is a big deal with $10 million, right? But when you got on, $700,000, $500,000, $1 million, it's not very much for them. So there's no incentive for them to do that. And if you only once in a while, or this is the first time you approach a lender, chances are you won't get the bottom pricing that you could have if you had somebody like myself or some other professional mortgage broker to help you. Right? So if I bring, for example, I bring 20, 30, 50 million dollars to that one individual lender every year or every quarterly, who's gonna get a higher rate than, right, you or me? If you only bring a smaller deal, of course, right? It's being facetious, but you understand what I'm talking about, right? So get somebody involved who's already a good big player in the field to help you get the lower rate, right? Lower pricing, and also expedite the whole process as well. So hopefully that answers your questions. There's other areas of that you may want to look at too, especially when the lender's appetite, and that's the one thing I'll touch base on as well. The lender's appetite is a huge factor to play too. Here's why. For example, there's one bank A is into farming, and because in the past they don't have a big portfolio into farms, now they want more farm on their property to spread the risk of put all eggs in one basket kind of thing. They don't want to do that, so they're incentivized to get new farm mortgages on the book. So that means this existing lender has nothing. They want more business, so they'll offer the bottom pricing for that. If the other lender has already got a big portfolio of farms, they don't want to take any more on. But because the reputation was on past that they do farming, so everybody sends deals to them. But at this time, guess what? Even though they have a reputation to do farming deals, they might get to do it. The high likely chance of doing it, but they're reluctant to give bottom pricing anymore because they've had enough, right, in their books. So for them, they want to disincent people to bring business to them. They want all types of business, maybe medical billing. Then they will offer lower pricing, right? Whereas this lender here is already offering lower pricing because they need that kind of business, right? Does that make sense? So if you're not in the business, the industry, chances are you don't know this. You don't know this lender is offering better pricing than this lender right now, right? Because they want that business versus they don't want the business. So it plays another role. Could be 10, 15, maybe even 0.5%, like 50 basis points is a big deal on multi-million dollars. Right? So hopefully that answers your question. There's so much variables in place: risk, property type, class type, and also bank's appetite. So those are the major ones that I can see when you bring any deal to the table. Other stuff will help you with the type of property that you buy, if they're in good condition or bad condition. That also affects. Right? That also affects the risk tolerance. That will affect pricing. Right? So hopefully this answers your question. If you have further questions, feel free to reach out to me soon at commercialfinancingmastery.com, SUA@commercialfinancingmastery.com. I'm more than happy to answer a question. Maybe even create a video like this for you in the future. Take care. Success to you.